Session 1 gave us a perspective of a company that has made the journey to TSX. Session 2 gets into another relevant route to the public markets for emerging defense companies. That is reverse takeover, or RTO. A TXXV has become a serious option for growth defense and dual-use technology companies that want access to the public capital without the timeline and the cost of a traditional IPO. An RTO, acquiring a listed shell and injecting your business into it, can be a faster, more capital-efficient path to listing, but is also a transaction that comes with real complexity, regulatory environment requirements, shareholder structure, disclosure obligations, and ongoing demands of a life of a public company. The two founders on this panel are not speaking about this in the abstract. They're actively pursuing RTO transactions right now. They're joined by a Dentons colleague who advises companies on exactly these transactions. Moderating session 2 is Kostic, a partner in our Montreal office with over 20 years of experience in M&A, private equity, and capital markets. Kosta, I'll leave it to you.
Thank you, everybody. Thanks again for taking the time to be with us this afternoon. My name is Kosta Kostic, and I'm a partner in the Montreal office of Dentons. I'm also a founder. I've done 3 CPCs personally over the years, and I'm on the TSX Venture Exchange Listing Advisory Committee for Eastern Canada, and helping public companies, helping startups get public, get financing is something that is near and dear to my heart, and it's a pleasure for me to be here with you and a privilege to be moderating this panel. And it's great to see 2 companies with us today that are going down the pathway, but at slightly different stages of development. Why don't we start off by doing a quick tour de table? It's great that we have somebody from Montreal, from Toronto, from Vancouver, and Ottawa here, reflecting a Canadian panel. So Ben, why don't we start with you?
Thank you. Okay. My name is Ben Iscoe. I'm a partner here in the Toronto Securities Group. Similar to Kosta, I sit on the TSXV Advisory Board in the Ontario region, and as Kosta mentioned, assist companies going public, and yeah, be it by way of reverse takeover or initial offering, and yeah.
Hi everyone, my name is Hunter Scharfe. I'm the co-founder and CEO of Juno Industries, and we're completing a CPC reverse takeover on the TSXV right now.
Good afternoon, everyone. My name is James Nguyen. I'm one of the co-founders and CEO of Quantropi, and I'm also doing RTO, looking to get listed in a few months here. And I run a dual-use quantum communications company based in Ottawa.
Yeah, and maybe, Hunter, just to give a little bit more information to the audience here about what Juno does and what you're focused on before we get into the finance discussion.
Yeah, for sure. So when I started the company last summer, I think it really came from a macroeconomic backdrop, which was we just finished a U.S. federal election. There was a Canadian election happening. And regardless of who won this Canadian election, there was really a sentiment towards buy, build Canadian, an incentive to sort of build domestic capabilities, not just within defense, but just generally speaking. There was a sort of a reaction of national pride. And then soon after that, after Prime Minister Carney won, there was this announcement of an increase in defense spending up to 2% of GDP. And I woke up and said, this is a generational moment backed by a generational growth cycle in defense spending to build a new type of company in Canada. And the approach that Juno took was to build what we call a neoprime. And instead of being a single product innovation company, looking at building a platform company that really knows how to win government business. Because if you're in the defense business, you're in the government business. And so we at Juno kind of break our business down into 3 pillars. The first is innovation and product. The second is velocity and capital, which is very relevant to our discussion today. Yeah. And then the third is government and armed forces intelligence. And that really breaks down into 2 things. The first is deeply understanding the needs of the armed forces and building products that are highly relevant to those near-term needs. The risk that a lot of early-stage companies take, and especially in this space, is building products that may not show up in procurement ever. This isn't like building a product like a wealth management SaaS platform that you can go pitch to RBC or BMO and sell all the features that the bells and whistles of a product. This is about building something for a specific audience and understanding what's on their grocery list and what their needs are. And the second part of that pillar is understanding procurement. This is a complex environment, knowing how to access non-dilutive funding, knowing how to win procurement contracts. These are all tricky, complex issues. And so we kind of view those three pillars as fundamental to our business.
Yeah, and you have former Mr.
Oh, yeah, that too.
Yeah.
My co-founder is the former defense minister, Harjit Sajjan, spent 20 years in the military and 10 years in the government, 6 of which were as defense minister.
Thanks, Hunter. And James, maybe you can say a few words about Quantropi, what the core business is of Quantropi.
Sure. So Quantropi is a deep tech cybersecurity company based on quantum secure communications, end-to-end encryption. We focus on enterprise, IoT, and defense markets. I guess the story comes from, banker, which is me. Me's quantum physicist, founded about 8.5 years ago. But it goes a bit deeper than that. There's a lot of hidden history to it. The chairman of our board was the president of Norton Networks. My co-founder was one of the lead scientists that built on the research arm of Norton Networks. And Canada has been at war for a long time, an economic war. We all know what happened with Nortel. And so these two individuals and their teams built and sold the network gear that builds today's digital infrastructure. Now they're back at it again with this team to preserve that legacy into the post-quantum era. I'm an ex-RBC banker, and one thing, my past CEO or current CEO of RBC, Dave Mackay, said is there's 2 things that keep him up at night. One is being on the front page of the Financial Post for a cyber breach, and the other one was becoming irrelevant. So for us, right, being relevant is very important in this era, and we believe that being protected against the threats of quantum AI is extremely relevant.
Thank you, James, for that, and Hunter for that intervention. Since this is a TSXV-focused discussion, and everyone here is anxious to learn about different ways to go public in the listing process, you've heard a couple of terms of art like CPC, RTO, things like that. I wanted to ask my colleague Ben Iscoe to maybe spend a few minutes maybe demystifying the listing process for those of you in the audience that haven't gone through it yet or thinking about it. Ben, maybe you can spend a few moments and just go through the process for us.
Yeah, no, I'd be happy to. So a CPC, Capital Pool Company, creature of the TSXV. Kosta was hoping that I could demystify, and I will give the TSXV a lot of credit that they've done a very good job of streamlining this program, that there's not a lot of demystification. It's a very, I would say it's a relatively straightforward process. You still file a prospectus to go public, but unlike other prospectus filings, this is entirely through the exchange itself. Their form is a prescribed form, not the typical one you would, extract from the national instruments. And you're dealing with the exchange pretty much top to bottom through this. And a lot of the paper, you will just recycle it from other transactions, customizing it to the CPC. A CPC, by definition, has a very, very specific business. So the description of the business for every CPC should be nearly identical. The numbers and names and dates will change. But the TSXV, I think, is very motivated to make it as streamlined a process as possible. Sorry, I thought the microphone was going up like yet. So okay.
Oh no, I'm just thinking I should be looking for another job then, Ben.
Yeah. And then the RTO, or the qualifying transaction for the CPC, I think some of the benefits were previewed. Subject to certain limitations, which I'm always pushing the TSXV to see if the OSC can lift. Your disclosure document is a filing statement, and again, it will generally be directly with the exchange. You're not going through the commissions. You're clearing all the comments through the exchange. The process, again, is relatively streamlined. If an issuer has, I would say, all their ducks in a row, audited financial statements, their disclosure is built out, their financing, they already have a banker lined up, and the financing can be launched pretty quickly. It can be a very quick process. I was on one, I think, from LOI to actual listing was 2.5 months, which is a pretty quick timeline, but that was a case of all hands on deck, audited financials in place. The TSXV, and I find this on every transaction, they have rules. They will follow those rules. I generally find that the managers that you're working with if you run into one of those rules, they will work with you to find a way to navigate it. It's not just a case of no, you figure it out and come back. The exchange, I think, is very motivated to have success stories, and they've created a regime to create a platform for those success stories.
And Ben, in your many years of experience with these, have you kind of found, is there like a particular sweet spot in terms of market cap or size of company that is well suited for the CPC program?
Well, for the CPC or for the QT?
QT, the QT, yeah.
I would actually say no.
Okay.
I would say that I've seen, I'm trying to think, like Canopy Rivers back in 2018, that was in a few $100 million, and one just went public 3 weeks ago that I worked on, where it was, I think their market cap right out of the gate was between 10 and 20. So I don't find that there's a sweet spot. I'm curious to know if the exchange has a different view. I think it's just a very streamlined process for a company that wants to go public and doesn't want to go on the big board, wants more lenient reporting obligations, doesn't want to have to deal with the AIF every year. So it's just kind of a stepping stone. And then I've also found the exchange has been very good about assisting with graduations from the TSXV to the TSX. So companies that eventually want to go up there, the stepping stone to the TSXV is definitely a part of that process, because the graduation is something that the TSX is very, very helpful with for companies that are looking to go to the next step.
Thanks, Ben. And I would maybe also add that, for those of you that don't know, one of the pain points when you're looking to go public is finding your public shareholder base. And so the CPC program provides that, because for the venture you need to have 200 shareholders, and so the CPC provides the public shareholders with a little bit of cash to pay the costs of going public, professional fees, a little bit of working capital. And in the recent years, the program has increased the amount of money that you can raise as a CPC. So it's an interesting tool for companies looking for some capital to go public. Switching gears back to our issuers here, I would ask perhaps James and Hunter if you can maybe describe the finance journey for each of your companies, which led you to consider the capital markets. And in particular, I would be very interested to get your view on the current finance ecosystem that we have in Canada and in your respective cities for high-growth defense companies. Because typically when we meet startup companies, whether they're mining or tech or in other industries, the venture exchange, usually people think it's a mining exchange, right? But it would be good to get your view, your description of your finance journeys, and some thoughts on the ecosystem.
Yeah, I think Juno was very fortunate from day one. We chose a path of looking for individual investors that really cared about what our mission was. And fortunately for us, it wasn't that hard to find. I think there's a lot of frustrated Canadians that, when we went out with a mission of reestablishing Canada's ability to defend itself, reestablishing Canada's Canadian dynamism, as we called it, it was a mission that a lot of people felt connected to, and we benefited from that. It was not from day one intent for Juno always to be a public company. I think what I saw, and I think a lot of people see, even just this week, the Globe and Mail shared, I think yesterday, that there was in Q1 0 growth stage investments in venture capital. 0. So for all those technology companies, and there's a small number of private companies that have succeeded and done well, but the vast majority, to my surprise, even with the context of this macro market and the keenness from government and all sorts of places, it's been a real struggle for private companies to raise money. So when I'm looking as the CEO of a company that wants to build a big company of scale, I want to find the path of least resistance. And that fact that I just mentioned about the growth stage capital, and just a general reality that for example, a lot of the venture funds that are at the pension-backed venture funds can't even invest in defense yet. Their constituents don't want to invest in defense. So I think it's an unfortunate place to be for a lot of early-stage defense tech companies in Canada that will continue to struggle to raise capital. And I hope I'm wrong. I hope that changes quickly. But that's just the reality. Another fact, I'm sorry, I don't want to be so negative, but the pension fund capital in Canada is generally about, on average, 7% of it is invested in Canada. So you've got this private landscape that looks kind of doom and gloomy. And lots of people in this room will recognize this, but generally Canada and Canadians often forget that we have this special little ecosystem called private or public venture capital. And some of the great performers comparing public and private companies are on the TSXV, and Danny mentioned one of them earlier with Kraken being a massive success, a company of global merit, servicing Anduril and other customers around the world. And so when our capital journey was pretty simply put a $3.5 million seed round that we did, our pre-seed round that we did last year, entirely done by, let's call it high net worth Canadian individuals. And we were fortunate to have a similar positive response with the listing. My lawyers don't let me call it a Series A, but a listing financing that actually did have some really positive feedback from institutional investors that I wasn't expecting. And so we have some participants in that financing that I don't think ever would consider a company as early as we are. But that speaks to another dynamic, which is there really isn't that many companies in this space to invest in that are public. And the few that are have performed really well, Volatus and Kraken, and I can name others. So yeah, I think that as a CEO, when you're considering all the paths, wanting to stay owned by Canadians, all these different factors, I'm really grateful that we picked this path with the TSXV. And the CPC element to this, it's a timing factor. When there's capital available, you want to pick the path that allows you to get access to that capital. And in addition to that, it's nice to have $1 million extra come with your listing vehicle. So gross between our 2 raises at Juno and the cash that we got from the CPC, you end up with about $16.5 million raised. And that's, I think, based on what I see, one of the biggest collective financings for growth stage technology companies in Canada. So we feel like we're in a really good position and very grateful to be on the TSXV.
That's great. And James, maybe we can hear from you about
almost on the TSXV.
Almost, yeah.
So Quantropi's journey started in January 2018. Since then, we raised a bit over $20 million US in call it seed capital. All of it's been from angels. So we have about 100 angels on the cap table over several raises. And I think, having the benefit of an experienced chairman and founding team that have built big companies is we operated pretty much as a public company from day one because we had a large shareholder base. We focused on governance. We looked at a long-term strategy, like 10, 15 years out. And going public was never on our mind, but it's basically always be ready to capture any opportunity that would come either in the capital markets, or basically in your industry. So we've always operated with that mindset in mind, but being agile as a startup. Regarding, kind of advising other tech founders or seeing what's available in the capital markets, as you can tell, I have no venture capital on my cap table. Not because I didn't want it, but it's absolutely really hard to get it, especially when you founded your company in 2018. So your first few years are with R&D, but then when you go to raise, right? You got the pandemic, right? And then you have rising interest rates. It's hard to raise money as a tech company, and if you're a deep tech company, good luck. And if you're a defense, forget it. So basically, I had to find patient capital that like to make early bets, right? On game-changing technology, that understood that, and really the hardest part is finding investors that understand what is going on, right? And what I mean by that is, so if you go to a VC that's backed by a BDC that's backed by a pension fund, whatever, right? They'll understand typically, hey, the business model. Okay, I got the business model. Okay, but then they don't understand the deep tech. Okay. I understand the deep tech, but they don't understand kind of defense realm. So then, right, and each VC, right, or fund has a different type of mandate and with a different type of specialty. And even if you try to marry them together, right, it usually doesn't work out because the terms, especially for something that is very high risk, is usually not favorable. So the deals usually never happen. So I think, luckily, we have a lot of, patriotic Canadians that have built things in Canada, right, and are looking at the next wave of entrepreneurs to invest into. I do hope that policy with the government, especially eventually getting flow-through shares for technology company, I think this is going to be the biggest impact for us. I think things are going to move positively for venture capital. It's going to probably take, in my opinion, another maybe 2 years or so before you actually start to see real money flowing to real companies, because the ecosystem, I think, has been kind of hammered a bit, right? It needs time to breathe, and they need basically people that are willing to make early bets, take risk, and be willing to lose money to build something.
Yeah, and I like the analogy with flow-through shares. For those of you in the room that are not as familiar with flow-through shares, it basically allows junior mining exploration companies to renounce or flow through their exploration expenditures to the investors in the financing, and the investors get a tax credit for that. So, from a policy perspective, finance, and CRA is willing to back natural resource companies. But what about, tech innovation and, the kind of, that's also a treasured resource in this country when you think of, Waterloo and, BlackBerry and some of the fantastic stories that came out of Canada and Canadian innovation. It's very interesting to see the different shareholder bases that you guys were able to get in. When you were discussing, additional capital requirements and the possibility of going public, what was the reaction of your core shareholder base? Was it viewed positively, or was there a sales process to get people comfortable with the idea of going public?
I'll go first. I had the majority of my shareholders were like really happy. Like, I've been around for almost a decade, right? Hey, a liquidity event, that's got to be good, right? But there's also this question, right? Did we get a good deal, right? Was the structure correct? All this kind of stuff, and we, signed the LOI right around Christmas, right? And we did another kind of bridge round, and we did all the stuff that's happening. So, and I think, this is where your investor base is so important, where you have to have that trust. They have to believe in you, right? Because, you sometimes you just have to move, right? And you have to move fast. And every investor is important, right? Just like every customer is important. Luckily, right, our CPC was a friendly deal. It was a clean shell. They had cash in there, right? Like, so they had like 1.3 million dollars cash in there. So it's like, and everything, people can read, the Global Mail article and say, okay, this makes sense. Okay, that doesn't look good. But I can call the company. So I think it's important that there's a lot of, you got to show that you did the planning. You also show that you're going to make good decisions. You have made good decisions. You have to show that your information is going to be accurate, right? I think focusing on the accuracy, right, and being able to quickly fix things if they need to be fixed. Like, for example, we took some money from an investor, and then we thought they were accredited. We fixed it right away, right? And I think, and being fully transparent with all that kind of stuff, I think that's important. But for us, it's like, I think we operated with core values in place and a culture. So I think for us, it's like, I think really having that mindset and that culture in place helps.
And how about your investors, James?
Yeah, I think there's certain people that really get public markets and understand that there's moments in time that are really a gift for this kind of opportunity. But honestly, anyone that pushes back, I just talk about the exact dynamic that I just kind of laid out, which is a stark reality. And again, I hope I'm wrong. I think the other thing is VCs can be really non-founder friendly. And if you've done an angel, if you invited angel and pre-seed investors in and go to a seed and try and do a VC deal, which we got a lot of those term sheets and turned down, there's all sorts of different things that end up being really tricky to make that kind of decision. There's preferred shares, double liquidity preference, voting power, board, and I just, as a founder, I go, I don't want that. I no thanks. But look, there's different. I guess for some companies it would be okay to take that path and take that risk. I just didn't feel it was right for us and our shareholders. And the previous panel did a good job of talking about this, but there's a lot of benefits to being a public company that people forget about. And I love the discussion about the benefit. We see a massive consolidation opportunity in Canada in this space and adjacent spaces. And it's not just our benefit, it's actually a great benefit for the target as well. You can look at a capital stack of a private company when you're public and say, okay, well, these people aren't going to want to do this, we'll pay them in cash. These people, founders, are going to we want them to stay on, they want to stay on. Let's get them an employment contract, earn out, so that they can grow with us. A lot of the conversations that we're having, I truly frame it as, this isn't an acquisition. It's more of a merger in the sense, like you're coming on to join our team in this vision, and that is infinitely easier if done properly as a public company. So yeah, certainly, generally speaking, there's lots of people, and of course the VCs go, don't go public, like don't do it, right? But that's obvious and a natural reaction. So yeah.
Yeah, I think that's very insightful, and I would add to that. A lot of people don't realize that in the startup world, when cash is tight, we often offer equity, right? Yeah. As a retention mechanism, as a way to entice advisors to join the boards and things like that. And of course, when it's a good private venture market, ecosystem, some of that equity, can be quite lucrative, but there's no liquidity. Whereas now you have a retention mechanism, there's a path, people can understand there's a market that I can sell my shares or my options once they exercise and I get my underlying shares. So it's a nice way to add. I think the gentleman of Velatus was talking about using equity for acquisitions. We can also use equity as retention and incentive mechanisms as well.
I just also wanted to say too, when you are public, there's always priced equity. So you can always do an equity round. Yep. And when you get to the later stages, in any scenario, if you're a private company running out of money, those options start to look really, really slim.
Yeah, no, that's we talked about the reasons for going public, right? And obviously every company is different, but that's the access to capital is obviously number one. And I think it helps also, with companies like yours and others that, when you've built your product, you have your proof of concept, but then there's that infamous, VC private equity valley of death when you're trying to, get money before you're revenue generating and positive. This is where, when you're on the venture, like you said, James, you have access to capital. You're not, there's no risk of, unless it's a bad market. But one thing that Danny showed you the statistics. I mean, the venture in the last year, almost doubled in terms of the number of dollars raised for companies, and it's not just mining. So it's an interesting space. How are we doing for time? I think we're okay. So the other thing that I just wanted to ask was, you're still early in your listing process, but for those that are looking at CPC partners, can you maybe just say a few words of what you looked for in a CPC partner, or how would you what advice can you give to folks that are looking for a listing partner?
Well, I think the nature of the CPC program is that it's favorable. It's simple, it's clean, as you were saying. There's not that many headaches, and there's a very predictable pathway to going public. So, I would just say if you were to weigh that against your other options that can either take more time or more expensive, say like filing a prospectus for an IPO, or something different like a true reverse takeover into a non-CPC shell. You can run into all sorts of different complications, debt, and the history of that company being complex. So the CPC offers just a very simple, clean option for companies. The nice part about it too is that it's very, it's almost SPAC-esque. So people understand it as well in a way. The average investor, you could say, oh, it's like a SPAC in the U.S. There's differences, but just generally speaking, they're kind of the same structure. So yeah, I think those are kind of the key benefits, and it's really more weighting against other options that you have to go public. And then pick the right exchange, TSXV, and have good lawyers.
Thanks very much. James? You have
Yeah,
anything?
so I agree with what Hunter said. When we were selecting a CPC, it was really around the discovery process. Do we want to go public or not? And if we were to go public, what's important to us? Because we know it's going to be a huge distraction. So we were like, how do we mitigate the effect on the core business? And first thing is finding a CPC that we can trust. We also want to find a motivated CPC. So so the one we found had a failed transaction, and we wanted to understand why that failed. We also wanted to find one with good cash in there, good management, frugal, this and that, because you don't know, it could extend, the terms could change. How do they deal with disagreements, failures? Just like you're dating, right? You're looking for someone to get married, right? So, it was really, can I call these people, right, and talk about like the deal, no lawyers involved, and then bring it. And the lawyers are just basically getting. It's like I need to be able to talk to my college boy, right? We're figuring things out, right? And it's okay to get a bit messy, but we want to make sure this succeeds. So the key thing is, do they want to succeed? Do they want to make money, right? Are they okay to spend money to make money? You have to have the same mindset. If not, and you're fighting about every little detail or all these legal jargon terms, then that's like the deal doesn't get done. So.
Thanks for your insights, everyone, and I think that's our time. Thank you for your attention, and we'll be around if you have any follow-up questions during the cocktail.
Thank you.
Thank you.